thank you everyone again for joining us today. Taking the time, as I'm sure this is a busy holiday season for everyone. But what we really want to talk about is, exploring mortgage notes as a real estate investment. Right now, in the past decade, a lot of people have looked at equity deals with, development or multifamily. And with what's going on, still want to stay in real estate, but don't know what other alternatives are out there that allow them to still be secured by real estate, but aren't necessarily um, equity deals in development. So, lovely little disclaimer. Again, we will send this out for everyone.
Like the iTunes or Apple where you just scroll through it and
Yeah. So, who are we? If you are an investor joining us today or not, my name is Lauren Wells. This is Chris. We are the founders of CWS Investments, which is an investment company that essentially invests in mortgage notes. So we purchase mortgage notes throughout the US, and those are secured by single family homes. And what we do is we like to say we fix and flip mortgage notes. So we buy them anywhere at a 40 to 60% discount of value. We increase the value of the loan by working with the borrower to get them reperforming. And then we sell that loan for a profit. So most of you might be familiar with the concept of fix and flip homes. So it's something I kind of draw the analogy to, and we'll kind of walk through that a little bit more in detail here shortly.
so overview of the mortgage note industry. This is something a lot of people ask, you know, how big is this industry? How can I get involved? And when you start looking at the numbers, it's actually mind blowing. The mortgage market is over $13 trillion of single family residential debt, which equates to just under 100 million mortgages in the US on single family homes. Which then when you talk about non-performing loans, at any point in time, there is typically between 2 and 5% of loans non-performing. Today, it's of course much lower because of COVID. The economy has been going well. So there's been more people who've been able to catch up and keep their loans current. I think a lot of the headwinds that people are seeing is we're going to start seeing an increase in that distressed debt. And right now, again, it's about $1.5 million, 1.5 million homes. But when you still look at 250 billion for people who are trying to get a small piece of the pie, there's ample opportunity. Anything like that, Lauren?
Just to kind of back up, when we talk about mortgage notes, kind of what that is specifically, essentially, we're purchasing the loans that are secured by a house. So when we purchase the notes, we don't own the property, we own the loan, and it is securitized by the physical asset, which in this case for us is single family homes. So when we're talking about how large the industry is, think about all the loans that are originated each year, especially in the last few years, we probably saw significantly more. And with government intervention ending, we're seeing, like Chris said, more people are going to be going into default and falling on harder times. So let's talk about this asset class specifically in the current economic environment. So like we just alluded to, inflation, lack of government intervention is going to lead to higher mortgage defaults. A lot of people really built up a savings, as we saw the data showed throughout COVID. And that savings, because of inflation and other factors, again, government intervention ending, student loans payments being due again, we're now seeing astonishing credit card defaults, and that will trickle down again into mortgage defaults. There's also a lack of inventory in the housing market, and inflated rents that are going to cause more distressed borrowers to come to the table as they're, we specifically, for example, work with these distressed borrowers. And when we do so, it's because, okay, what are their other options? There's really no place to rent. And if they do go rent, it's probably going to be more than what their mortgage payment is. So it really has brought a lot more people to the table to work with us. And then we also have significant equity coverage. So this is always important because if there is a dip in the housing market, are we still secure? Is there still equity for us, for our investors, should, the borrower decide not to come to the table?
Yeah. And one question we get asked a lot about this is, well, 2008. And, are we going to see another 2008? And today is very different than 15 years ago, where 15 years ago, there was a lot of unqualified people getting mortgages, but also housing. Uh, there was a huge ramp up in sales of houses, and then the prices dropped dramatically. Today, people, there's not a lot of houses being sold because of interest rates. A lot of people who bought pre-COVID have significant equity, as Lauren mentioned.
Mhm.
So a lot of the default strategy that happened 15 years ago is very different than it is today.
Yeah, and I think that also just in 2008, because we do get asked this question a lot. In 2008, we got a lot of there was a ton of inventory of houses. So people would just walk away, walk away from their home, take the bankruptcy, file for bankruptcy, walk away from the home. Whereas today, that's not really an option because there's no place to go. So again, provides more opportunity for us. So what motivates sellers, being banks, funds, credit unions, to sell loans? Like, why? We get this question a lot. Why would a bank say, hey, I want to sell my loans? And Chris, you have some great examples here, so I'll let you kind of take this one.
Yeah, one I like to use is think of, an automobile manufacturer. They are built to have the vehicles come off off the assembly line, and nothing goes wrong with those. Banks operate the same way when you look at these large institutions. When a mortgage goes into default, that kicks it off that quote unquote assembly line. So it's a whole brand new team have to start getting involved in taking care of that mortgage. And this is not a knock against large banks, but they have a lot of systems and inefficiencies. As you get larger, you have more redundant systems, more people you have to get approvals from, and then time becomes of the essence. So it takes so much longer. So that is one reason why banks will. And then, get really technical, we can go into fractional lending, which I'm not going to get into by how banks create money. But, people are bored some weekend, they can read that. And then the other is also the location. For example, we have a loan or bought a pool of loans that had a loan in Montana. We don't have boots on the ground in Montana. We didn't have, a servicer we prefer in that location. So there's nothing wrong with this loan, but it was an example of it's not in our best interest or best use of our time to own a loan at that location. And I'll let you talk about some of the others, Lauren.
Yeah, I was just thinking about, banks focusing right now on liquidity. And so they wrote a ton of paper or they wrote a ton of loans at 3%, which are losing them money at this point. Like we saw with Silicon Valley Bank. So now they're focusing on rebalancing their portfolio, making sure they have that liquidity. And really, banks are very, very good at creating debt, as we've seen, it's their job. Managing debt is a whole other animal, and that's kind of where it's either okay, I can spend the time like Chris mentioned, or I can sell these at a discount and rewrite paper at 6% to start making money. Or actually now it's like 8%.
And the last I'll mention is like we buy a lot from funds, and some funds strictly only deal with performing loans. And when it goes non-performing, they have zero experience with that. So they will just liquidate it off their books as well. So that's another, of course, reason. Lauren, you want to talk about the
Yeah.
typical reasons of borrowers?
So I think something that's a good thing to differentiate here is there's a distressed property and distressed debt. So when we think of distressed, we're not saying the property is in distress. It's the debt and the obligation to fulfill and make their payments for the mortgage that is in distress. And typically, one of the biggest misconceptions we hear is like, oh, people just wake up and they're lazy and they decide today is the day today is the month I'm not going to make my mortgage payment. What we found is about 95% of our portfolio, that is not the case. We've done over 700 transactions at this point, single loan transactions. And that's for 95% of them, that's not the actual case. The 4 reasons you see here listed: job loss, health, divorce, death, something happened during COVID. Those are typically the reasons that caused borrowers to stop paying. And that's really part of our due diligence process. And something we really look into when we're looking at that acquisition process is what did cause them. If it was, we see a random stop payment and we see servicing notes that they lost their job, that's a very different situation from buying a loan where we see a track record of someone who's filed for bankruptcy 7 times. That's not probably a loan we'll take on. That's a very different type of borrower from someone who lost their job and fell behind.
Great points. I have nothing to add. Leave that one. So do you want to take debt versus
No,
equity?
go for it. You go
Okay.
for it.
So let's talk a little bit about debt versus equity in mortgage notes and really understand the different types of investments. Because in a debt investment, typically it can be an unsecured debt, which then when things are unsecured, is a higher risk asset. Where, with investing in an equity fund like ours, it's can be secured and tied to one or multiple assets. You see this profile a lot in multifamily deals where there's that debt profile that is in front of those investors. And then, as we mentioned, kind of that equity risk profile where, you're secured. It's conceived to be a lower risk, and that risk is spread throughout those portfolio of assets. You didn't mean to.
So just while you fix this, I have another
Yep.
point to make.
Yep.
So when we talk about the return profiles and like higher risk versus lower risk, what Chris is talking about is really like where do investors fall in what we call the capital stack. So in like the multifamily deals, there might be a superior lien that comes. So if something goes sideways in a deal, the question that an investor should be asking, hey, if things hit the fan in say this multifamily deal, and I'm not picking on multifamily, this is an example I'm using. Am I paid first? What loans do you have? Do you take any additional equity, or do you have an additional loan that comes before me? So does JP Morgan need to get paid before investors get paid? And how does that affect me? So that's what we're talking about when we're saying higher risk with where they fall in that capital stack. So just an important question, I think, to kind of throw out there for people who are evaluating different offerings is, where do I fall in the capital stack as an investor? What happens if things go sideways? Who gets paid first?
And also understand that risk profile, because there is a mortgage note fund out there that they issue what's called LROs, or limited right obligations, which, like, what is that? And really it's a kind of like an unsecured IOU that, well, it's tied to a note, but if this note pays, then you get paid. But if it doesn't, then you don't. But if something happens, then you still might not get paid. So really understanding and asking those questions up front is something I recommend to every investor.
Yep. Go ahead, Chris. So one of the questions, I'll go ahead and start off and you can add on, I'm sure.
Okay, yeah.
So one thing we get asked a lot is, how do current interest rates affect, your asset class and what you do specifically? So we always say that we're interest rate agnostic, because when we're looking at a tape of loans to bid on, we're bidding based on a specific yield we would like to achieve. So for example, if we need 12%, a 12% return, and the loan was written at 6%, then we'll need a 50% discount, or we'll bid 50% less. And then if it was written at 3%, we'll know we need a 75% discount to achieve that yield. So while interest rate affects our bid price, it's not something that is a direct impact on our business, because we are not originating notes. We are simply purchasing them, fixing them up, and selling them back on the secondary market. So
You hit that nail on the head. And, like you mentioned also, or we're going to mention is, other asset classes, they are interest rates has a significant impact on most assets within real estate. So that's the one thing that's great about notes is when you're bidding off of a targeted yield, that interest rate, like you said, is
So we probably should have put this at the front end of the deck now that I'm looking at this. So, mortgage notes are investing is an alternative strategy secured by physical real estate. Remember, you're becoming the bank and the borrower still owns the home. You're just collecting the mortgage and principal and interest payments. Note investors can buy loans from the sources of the sellers being, banks, private lenders, credit unions, hedge funds, brokers. And then depending on the type of, note, whether it's performing or non-performing, you get a significant discount on that, which is kind of where we come in, purchasing them at a discount, adding value, and selling them on the secondary market.
so This is another great question we ask, and this is usually one, the most mind-blowing question is when we talk about performing and non-performing loans, which the definition should seem pretty easy. Performing loan is when a borrower is meeting their obligations and paying on time, and we typically will buy them at a discount. But the definition of non-performing, because most people, it's ingrained that, oh my God, I missed a credit card payment, I missed a mortgage payment. Like they're gonna, they call you 100 times, they're gonna come knock banging on your door, they're gonna start pulling you out of your house. That's not the case. A non-performing loan is actually 90 days or more past due. And that's why it sells at a considerable discount. And Lauren can add what the average delinquency rate is on the non-performing loans in our portfolio, because that stat usually gets a lot of people asking a lot more questions.
Yeah, honestly, we've updated. I haven't looked at it recently. Can you
Oh,
allude to
okay,
that?
so it's about 3 years. So, our average loan is, about 3 years behind. So, and that goes back to what Lauren mentioned earlier of, people just don't wake up one day and stop paying. But what happens with these banks a lot of times is it's that snowball effect of, okay, you missed 2 payments. They're like, well, now you have to make all three. And the person's like, I just got a job. I can make one. And then they're like, the bank will take 2 months to get back to them. And now it's like, okay, well, now we need five. And you go through that repetitive cycle back and forth. Next thing you know, they're a year behind. And then we'll read the servicing notes and we'll see, and we have case studies we can share, that people want to pay, but it's nobody will get them on the phone and actually have a conversation, a back and forth in regards to how to work that loan.
It's really it comes down to the flexibility
Yeah.
of, you know, us versus big banks, which are inflexible and don't have processes in place to really work with borrowers, let alone pick up the phone or send an email.
Yeah.
So why now? So we kind of alluded to this a little bit, but, inflation and, lack of government intervention is going to start putting more pressure on homeowners. It already has been putting pressure, which is going to give more opportunity for distressed assets to hit the market. And kind of that simple supply and demand, the more assets that are available, the better price and the more ability for us to cherry pick what assets we take on. So to kind of give an example of, what we've seen over just this year is in Q1, we evaluated 300 million in the entire first quarter of loans that came across our desk. Q2 was about 300 million a month, and Q3 and Q4 about 300 million a week in loans coming across our desk. So we've seen literally over this year kind of the floodgates start to open with inventory, which for us, again, has allowed us to better pricing, cherry pick more as far as which assets we specifically want to take on, and be a little bit pickier in that sense.
Yeah. And if you look at kind of, I'll say the big boys, the Black Rocks, and a lot of these, billion-dollar companies, if you hear the term private credit, that's what really distressed debt is. It's the fancy name, private credit. And a lot of them are going after a lot of the commercial because of all the distress that's in the commercial space. So right now you can already see a lot of people looking to move into that space, but most of them are going to commercial because on that residential side, you really have to be super niche and understand that space because of the compliance with the laws when you're dealing with consumers and homeowners.
So we talked about earlier what mortgage note investing is, and that's really on like the individual looking to try to invest and create their own portfolio. Now, why is a mortgage note fund different? So essentially, you're investing without the headache of figuring out the entire team, the vendors you need, what are good assets? How do I evaluate? How do I bid? You're investing in the team and their expertise and their track record versus your time, energy, and resources, which you may or may not have, or may or may not want to take on your own. So another reason is collateral. So real estate, as we all know, is one of the safest investments. So unlike stocks, they are backed by collateral, and that collateral for mortgage notes, and specifically our mortgage note fund, are those single family homes. So secured by physical property. The versatility. So something that Chris and I both love about this asset class is there's not just one exit strategy. So yes, typically we sell them back on the secondary market for a profit. We've also worked with borrowers. Borrowers can refinance, they can sell the home. We can work with them to do some sort of modification, get them performing and hold the loan. So there's just not one, oh my gosh, if this doesn't go well, then this, if this one exit strategy doesn't work, then all is lost. So we really can get super creative when we're in this asset class. And then a fund kind of to add an extra layer is not just one note. So when you're investing, you're not just saying, okay, here is my money, it's tied to this specific asset. And if that goes well, great. And if it doesn't, I'm out of luck. You're tied to the entire portfolio, which is just over 100 loans at this point.
I have nothing to add. I know. Goes into, you mentioned a little bit about this of, how we do make money in notes, and you with the fix and flip. I'll let you start with this because you always you speak about that.
Yeah, so there's really three main ways. Chris mentioned this earlier. When we buy loans, for example, that loan in Montana, where we didn't have a servicer or really any loans in Montana. So when we say liquidate undesirable loans in a tranche, that would be an example of an undesirable loan. Not undesirable because it's a bad loan or a bad asset or anything like that. It just doesn't fit our specific criteria or buy box. So, however, we've been in this industry just under a decade. And so we do know people that, we know we can reach out to these buyers and they'll be interested in these loans. So that's one way we can liquidate undesirable loans in a tranche and make a quick kind of flip return there. The second, and this is where about 95% of our portfolio falls, is we negotiate a payment schedule with the borrower. So they come to us they're behind. We work with them to get caught up on their arrears or past due. And then we get them reperforming, generating cash flow while we're generating cash flow from these payments. And then the exit options are sell it as a performing loan on the secondary market. The borrower sells the home and pays off the loan, or refinances and pays off the loan. Again, the bottom two are less common right now. During COVID, we were seeing record refinances and getting paid off left and right. So, and then the third and probably smallest part of definitely the smallest part of our portfolio is taking ownership of the home. So that would be for that 5% of borrowers who say, I'm not going to work with you. I'm never going to make another payment again. They have no intention of coming to the table. Or it could be a house that was inherited by, there was a death, the borrower died, and it was inherited by family who no longer wants the home and just wants to get rid of it. So taking ownership of the home, meaning going through that foreclosure process, either it will be sold at auction and we will get paid off, or we take back the property and then we liquidate the asset. So one thing about us and our fund specifically, and again, I always like to throw out things I would be asking if I was investing in any sponsor with any sponsor is, what are you focused on? Are you doing just notes, or are you taking back the properties and becoming, and managing them? So we are not in the business of holding assets, renting them out, managing them. We are uber focused on mortgage notes. It's what we have done in our past funds. This same strategy is the same strategy we've employed. So I think focus is, especially in this economic climate, something that should hold a lot of weight when you're looking at different investment options. So just something, again, to consider when people advertise they're a, mortgage note fund. Are they really, or are they doing mortgage notes? Are they doing office space and cryptocurrency? And it's all kind of packaged as a mortgage note fund because the majority of it is mortgage notes. So just questions to ask. And that doesn't go for just mortgage note funds, but all investors.
Two things I'll add to that, Lauren, which is interesting because I'm looking down and we talk about like liquidating that undesirable loan. And this business is such a relationship business. It's like any business. It's it's a small industry. Everybody knows everybody. And I say that because the person that bought that loan just sent me the nicest Christmas card I probably ever seen from them. So I got that sitting right in front of me. So just mention that about, we have those relationships where we can sell loans outside the portfolio. The other I'll mention, people ask a lot is, well, why don't you like fix it up and get maximum value? And I spent 20 years working, in development and construction, and managing any type of project, even when it's literally next door to your house, is extremely challenging and time consuming. Trying to do that in assets that are 500 or 1,000 miles or even 30 miles away, it's just a completely different business model, and goes back to what Lauren says, is you want to know what their focus is, what their target is. And that's something that we, take pride in, is making sure we are extremely target focused.
Yeah. So risk mitigation and due diligence. So kind of walking through, when we get a tape or a list of loans, it's really a glorified Excel spreadsheet. It tells us everything about the loan. It's like line by line of each loan. It says who the borrower is, the property, the value, the principal and interest, payment monthly, the interest rate, when it was originated, when it went into default, when their next payment due date is, any legal, basically everything you could probably want to know on a note is in a single line item. So what we do is we go through and we pick and choose which ones we want to bid on based on, our buy box. And we also just assign a indicative bid. And so think of this similar to buying a home. An indicative bid is your bid if you were to go and see a home you liked and you're like, okay, I'm going to place an offer. Well, the seller can come back and say, okay, I accept, I counter, or I reject your offer. Similar again to buying a home. So once you come to an agreement on a specific price for the assets you're looking to acquire, then you open a escrow or due diligence period of anywhere from 3 to 4 weeks. And that's where we do a deep dive into the property, the borrower, the situation. So we run title, we look at the servicing notes, we assess the value of the property to make sure it's in alignment with what was given to us on the spreadsheet. So it's really we trust this information we were given. Now we're going to verify it with all the different things that we do in that due diligence process. Now, we are bidding based off several different exit scenarios. And what we do is during that due diligence process, if we find something that is a huge red flag, for example, the property value listed was say it was listed as a value of 400K and it came back and the property is actually only worth 200,000. That is a huge difference in when we modeled it. So what we'll do is we will either fade our bid to match the current value that we received, or what we'll do is we'll pull from acquiring that asset. So yeah, anything you have to add?
And just overall, I could talk all day about this,
I
Lauren.
know it's a hard one to summarize in like 5 minutes or less.
No, a few things though. This is really where the investors make or break the money. It's
Yep.
on that due diligence, because you have to take all the risk that gets factored into this, and how are you going to reduce or mitigate that risk? And like you mentioned, it's all about understanding the property, the borrower, the situation, and going through all of that paperwork. Now, just want to let people know from a timing perspective, how long does this usually take is a question we get asked a lot. About 2 weeks. This is a week to 2 week process that you go through during that time. So, it depends on whether it's one asset or 100 assets. Of course, 100 assets take a little more time. And this is where experience matters, because there are so many situations that I've been through that lessons learned is, a term I like the phrase of, a missing, signature on something or whatever the case may be. So, and, you really need to be detail oriented and focused on this and have people that can do that, which is something that I think we excel at.
And then the equity aspect of it. So the investments that we are investing, or the assets we're buying, have significant equity. And I think this is, Chris, if you want to walk through this, a good example of kind of what that looks like.
Yeah. And as we mentioned early on, it's a very different situation than it was 15 years ago. A lot of the loans we buy were originated well before COVID. So we might have bought a property that's from 2014, where today that has a $250,000 value. And let's say it has a $75,000 balance on it. So they've been paying their mortgage or may have fallen behind a little bit during that time. But, because they probably paid $100,000 for that asset, but now it's worth 250, they've got 30% loan to value. Now you kick into the factor that we're also buying that at a discount. So
Mhm.
we're buying it for $45,000, that loan. Now all of a sudden we're at an 18% investment to value. So why does that matter? Because what's going on today? You know, home prices are starting to, in many areas, soften or start to come down.
Oh, yeah.
Now, home prices dropped, 50%, which has never happened. You know, we still have coverage in our portfolio. So this is one area where we like to focus and target, not only when we talk about those due diligence factors, very important that we understand and get as accurate as possible evaluation on that property.
Mhm.
Anything else you'd like to add, Lauren?
Nope, covered it there. So what is our fund? What does it look like? So we have, like we've mentioned, if you've heard from us before, a Regulation A plus offering. And kind of want to back up here before I talk about the terms, that they're there so you can see them. Everyone loves to see the terms and asks about those. We should probably put this at the front of the slide deck just to get it out of the way. But I think that's important to know kind of how the Regulation A came to be and our story behind it. So Chris and I actually started as individual investors on our own. We did not know each other in this space, using our own capital to build our own portfolio of loans. Now, through doing that, and for Chris a little bit longer than me, we met at a conference, and Chris had been doing a ton of joint ventures. So kind of when you look at what brings sponsors people who are, have funds, so they call us sponsors in the broker world. Um, so when you look at how people get to, okay, offering a fund, I always kind of want to look back at, like, did they just do this once and then decide I'm going to do a fund? What was that progression? And for me, what's really like comforting is when I see kind of the natural, okay, we took the stair steps, we've, evaluated, we've had a few offerings under our belt that were smaller. So what we, with Chris, we both started with our individual portfolios and had success. Going into joint ventures, I think Chris, you had done over 200 joint venture deals.
A
If I'm,
lot.
yeah. So, and if you don't know what a joint venture is, that's a one-on-one transaction that where it would be one note, Chris would manage it, an investor would fund it, and they would, either have their own terms as far as how they would each get paid. But that's a lot of at bats, is what I'm saying. So then you go into launching your first fund. So, different iterations of that. There have been 5 funds that have gone full cycle, where I helped Chris manage those from an asset management perspective. And those were all a little bit different than this one we have today. But again, and we're all successful in that we did not lose an investor's principal investment, nor miss a dividend or distribution payment, and we hit their expectations as outlined in the PPM. So that brings us to the Reg A offering. And one thing that I think for Chris, and I know, Chris, I won't speak for you, but for me was when you see all these joint venture deals and then you kind of look at what the funds have to offer. If you don't know much about investing in funds, something you should know is that there's a lot of funds that are only available to accredited investors. And you're leaving out a huge portion of the population that wants and should have access to invest in alternatives to balance their portfolio, especially in times like right now where the stock market is not doing so great. Those investors are really kind of left out to dry, while accredited investors have significantly more options. And so for me, behind the Regulation A, it's kind of looking at my former self, 10 years ago, wishing I had these options to get started investing. So we have the Regulation A plus, and that's kind of what birthed the Regulation A plus, was giving everyone access to invest in an alternative asset class that was secured by real estate. So what I mean by that is you don't have to be accredited. It's open to anyone, accredited and non-accredited. It is a 4-year hold. The minimum investment is $5,000, though we do start offering bonus shares at $25,000. And it's a preferred dividend payment of 8%, annually, paid monthly. So if you're super tax savvy and want to run it by your CPA, as I am not a CPA, nor do I give financial advice or investing advice, it does have some tax alpha in that we are giving you a 1099 at the end of the year, not a K1, which is taxed as long-term capital gains because they are qualified dividends and not ordinary income. So again, if you're considering investing in anything, I would always ask, one, I would always bring your CPA into the conversation after you've talked to the sponsor so that you can understand what are the tax ramifications. Am I going to get a K1? How does that affect the actual return I'm getting if I'm taxed at 37% versus a 1099 dividend where I'm taxed at 20%? Again, and then kind of run those scenarios by your accountant to see how this actually affects your return.
Yeah, and you had a great conversation with somebody last week that you did a LinkedIn post explaining that people a lot of times just look at that top number and not understanding all the tax consequences. And then sometimes that little light bulb goes off. And one thing I just want to add to that is exactly what you said, Lauren. This was a 6+, almost a 10-year progression of, getting to the fund point, to the regulation A. It wasn't, we did 5 deals and basically like, okay, it's hot right now, so let's just try and raise as much money as possible, that you've seen in other asset classes. Multifamily. And again, I'm a multifamily, invested in multifamily, and people sometimes try and rush that progression. That's something, not everyone, but that's something that I think I take a lot of pride in, is making sure that as I went through this progression and working with you through this progression, that we were very methodical in every decision that we made.
Yeah. So I think
Case studies.
we have some case studies. So now we can give you kind of some examples of what this looks like in practice. So Chris, I'll let you go ahead and take these.
Yeah, so this was a house in Maine, which I love the look, being from the Northeast, but when my California cohorts are like, ooh, not really. But this loan, again, we talk about that equity. It was a $500,000 house that had about $125,000 balance on it. We acquired it at a discount at $80,000. And at the time, we call it semi-performing. The borrower was making payments now and then. But what we found is when right before the purchase, a little over a year ago, the borrower was renovating the property because they're listing it for sale. And the reason why is the woman's, unfortunately, her husband passed away and she was downsizing. So we knew that information. We modeled it based off of many different scenarios that included a lot of conservative estimates that ended up, essentially, the borrower paid off the loan in less than a year. So goes back to that exit strategy that Lauren mentioned. It's not as frequent now that people are selling their house because of interest rates, but there's still people selling, and this is a good example of it. Mm-hmm. Anything you want to add, Lauren?
Nope.
This is more what I'll say the bread and butter of note investing for us in our exit strategies. This was a loan, $66,000 balance, bought it for just under $50,000. Again, significant equity, non-performing loan. The borrower at this point in time, was, behind. And what happens a lot of times we see with borrowers is, and I have this, say I pay my credit cards, but when you get a credit card payment, the statement, you just throw it away. I mean, I never open them. And borrowers, when they're in distress and they get their statements, if they know they can't pay, what do? They just put it in the trash. So they kind of just ignore the issue a lot of times. So what we'll usually do is have an attorney just send a demand letter. Law offices of XYZ, gets their attention and brings them back to the table of, oh, someone's willing to work with me now. And this is what happens in this instance where, we bought it in May. It took several months to get in touch with them. But since that time, the borrowers made over $6,000 of payments to us. And now they've agreed to pay double payments every month until they're current. And the reason why they're behind is, again, a job loss during COVID. Now they're back getting their money or creating that income that they can now try and catch up. And this one, again, is very similar to the other one, but we just added a little flavor to this one, because of the other options that are out there that a lot of people aren't even aware of. And like Lauren said, we have very low foreclosure rates because one of the things we want to do is we try and work with the borrower because it's actually, be honest, more profitable for, us, and also keeps them in their home. And here's an issue where this was a lower balance loan. It was a $200,000 property that they only owed 20 grand on. We bought it at a steep discount because of it being that low balance. When we purchased it, we contacted the borrower and we mentioned, oh, by the way, have you applied for home assistance fund program? And they're like, what is this? And most states have these programs where they help homeowners stay in their homes. In this case, they did. And what they basically, in this instance, is, they cut us a check at the time, basically for, close to $11,000 because of all the amount that was past due on that loan. So the state stepped in basically and, said, hey, you can't sell your house for, next 6 months, a year, whatever it is, which person, again, today, who wants to, where are you going to go? So we got a check for $11,000 from the state to bring the loan current. The loan is now performing. That balance was mostly, the balance didn't move much from the 20,000 because of all the accumulated interest on the loan. And then we turned around and we sold that loan once she started making payments again to an investor who has an IRA that wanted that cash flow, and we sold it for 10,000. Like I said,
So
go ahead.
yeah, so Q&A, we do have quite a few in the chat, so I'll go ahead and read those and we can answer those.
Right.
So does Seveney have to maintain or keep up with specific licensing to continue to execute this business year to year? Does your team make continuing education courses based on the market shifts or regulation changes?
So I'll hit upon each. There's several questions there. The first is specific licensing. Yes. So certain states, we are required to either have specific license. We actually, I hit the approval button on that invoice this morning to renew our licenses in the states that we need to. So that is that first question. And then continuing education courses as market shifts and regulations change. Yes. So we are part of a company called ACA International, American Creditors Association. So they are an association that is all up to date on the ever-changing laws, and we take courses through them on an annual basis. And that is extreme. That's a great question too, because one of the challenges of note investing is, unlike owning a home, whether you buy a house in Texas versus California, your taxes, insurance, and, besides an HOA or certain things might be different, but, you're buying a house and your mortgage is your mortgage. As a lender, very different laws in every state. So we have to stay up to speed on every state, which is important, why we're part of those associations, as well as our attorney network and connections.
Yep. There's a few. Are there more entities buying non-performing loans nationwide or in certain regions? Is this an asset that most investors stay away from?
Great question. So, we typically will buy, for the most part, I'll say nationwide. I'll use a term, we stay away from the top tips of the country, the Northeast and the Pacific Northwest, from New York up and then the Pacific Northwest, just because the foreclosure timelines and the laws there are extremely challenging. And it can take, in New York, for example, 5 years to foreclose on a loan, which that doesn't fit our profile in that instance. And do investors stay away from non-performing loans? It depends on the investor. I just want to reiterate, note investing on your own, whether it's performing or non-performing, is not mailbox money. I know some people will say, oh, you can invest very passively, in this business. Unless you're investing in a fund, there's work that has to be had. So it really boils down to that investor avatar.
So I can speak to that a little bit more too, and
Yeah.
I'm sure you can as well, Chris, because that's how
Mhm.
we both started.
Yep.
But I think there's two parts to that. I think, like Chris said, when I got into it, I was, coming off of a W-2 job and thinking, how can I have mailbox money? And all of these, what can I invest in? Real estate, great, check. What aspect of real estate? And then I was introduced to mortgage notes, and was very much fed the this is mailbox money. Now, while a performing note can be more of a mailbox money avenue, that's not necessarily the case most of the time. And then in non-performing, typically not at all. There's a lot of vendor setup, coordination, a whole bunch of players that you need to have like basically on your team that you're managing day to day in order to, build a portfolio. So it's definitely not passive in that sense. However, it could be done, but you do still need time. It's not passive as if you're investing in a fund or, whatnot. And then the other aspect to that is really the regulations around this asset class have shifted drastically from when Chris and I started. So COVID really, shifted the dynamic of people wanting to get into this as individual investors because of the different licensing requirements, debt collection, what was considered a debt collector. During COVID, the CFPB, which is the Consumer Financial Protection Bureau, which like sounds like some kind of super agency. They really cracked down on who could collect debt, how you can do that, how you can communicate with the borrower. I saw people who had been in this industry for years. I'm talking, since the early 2000s, get out of the industry because the way that they were doing things no longer was compliant with, the regulations of today. So it is definitely something that has changed and shifted. Next question. How does your portfolio treat opportunities with intercreditor agreements?
Yeah, so I'll take that one. We don't have any intercreditor agreements. We don't have any, warehouse correspondent lines or anything along those. Investors we have no debt at this time. So investors who invest are issued shares as preferred equity shares above the common shares that Lauren and I own. So so we don't have them within the agreement.
And then where do you get most of your NPLs? Also, are they all consumer mortgages or are they business purpose?
So most of, our NPLs, we've got, my list is probably 30 to 50 people we buy from. Typically it's whole loan traders and M&A companies, merger and acquisition. People like merger and acquisition, why? And a lot of banks, again, banks are in, when I mentioned early on, banks are in the business of streamlining everything. Banks, when it goes non-performing, they don't have the list of, okay, who can we sell to? All these merger and acquisition companies, again, they're set up for it. The bank will then give it off to the M&A company, and the M&A company actually will take a fee from the buyer, but the seller's not getting charged to handle all of that paperwork, documentation, and that process. So if you can have somebody do something for you that doesn't really cost you anything, of course and you don't have the people to do it, that's where we see it. Others, servicing companies, other investors, and of course, other funds are the top people we see loans from.
Will the fund ever move to a reinvestment option for investors for dividends? We don't anticipate that at this time. However, maybe in a future fund for this fund. Yeah.
Mm-hmm.
Can I utilize, I'll take this one. Can I utilize my self-directed IRA to invest? If so, how do I do so? So yes, if you're with a custodian. So if your self-directed IRA is with a custodian that allows you to invest in alternative assets, physical real estate, precious metals, other alternatives, as they call it, and some of those are Quest, Strata, Advanta, Madison Trust, New View. So if you have an account with them, a self-directed account with them, you can invest with us. And if that's something you're interested in doing, you can reach out to us and we can kind of walk you through that application process. We have great relationships with all those custodians, so we've made it pretty seamless on the investor. Do you have an example of a note that did not go as you anticipated? What did that look like?
Absolutely. So one of the things I'll start with, as you mentioned, Lauren, we've been doing this for so long. Of course, we have notes that did not go as anticipated in a negative fashion. And what is one of the things that differentiates us about that is we have historical data on every single asset in every single state and how does it perform. So we're always updating our models. So, definition of insanity is doing the same thing over and over again, expecting a different result. So we are making sure we don't make that same mistake. One that sticks out to me was early on in my note career. This was many years ago. I bought a loan in Ohio where it was non-performing, and it just something didn't something wasn't right with this loan for some reason. I don't know why. I had that gut feel that that something just wasn't right about this, because it was like $100,000 property. A guy owed 30,000. From the outside, it looked like a great loan, and it's like, why isn't this guy paying? So lo and behold, we end up finding out that the gentleman who was living in the property wasn't living there. He moved next door because he had a flood inside the house, or he had a plumbing backup, and the basement ended up having 5 feet of water in it. So in that instance, he just let 5 feet of water sit. And we were trying to work with this borrower. He would not let us work with him to get the water out of the property, anything along those lines. So you can imagine what happens to a home that has 5 feet of water sitting in it for a year time in Ohio, where it also gets very cold and snows. So this house was completely filled with mold. And it took us an extremely long time to work with the borrower to get the water out of the property. And what we ended up doing was we ended up working it out, and we ended up working with the borrower to sell the property. And we worked with him to sell it to an investor who ended up buying the property because they would rehab it and everything along those lines. So, at the end of the day, that when I mentioned earlier on about understanding property value and what a property is worth and making sure you do your due diligence, this is a perfect example of a lesson learned that we've implemented policies and procedures now that we have very different than 5 or 6 years ago to make sure this doesn't happen again.
Where are you headquartered? How many people on your staff? We are headquartered in Virginia. We have 9 people on our staff. What recourse, if any, do investors in the Seveney Fund have if payment isn't received, or in the case of bankruptcy or default?
I'll answer this, but again, I am not a lawyer in any way, shape, or form. This is not something we anticipate. But what I will say is, standing here in front of everyone today, we do not have any lines of credit. We do not have any debt. There is no bank that can come in and say, "Oh, you owe me all of this money." The investors are equity investors in the offering. So if something were to occur and all the assets get liquidated, basically the investors would get paid first. So that is how we structured the fund. And Lauren, if you want to kind of talk also about kind of our fees as well, about how no fees, because I think that's important as well.
Yeah, so it kind of comes back to that capital stack discussion that I talked about earlier, and like what happens if you do go to, so way to use this question, you were listening. So if like Chris said, investors are first in line. We don't take out any additional loans, or we don't have any other creditors. So essentially, and we don't, and this is important, have any fees. So when you're looking at evaluating, like, who should I invest in? What kind of asset? What kind of sponsor? What does the fund look like? Not only do you want to look at tax ramifications, because that definitely will skew the return, but also you want to look at fees. So do they take an acquisition fee? Are you paying an account fee to have access to like an online account? Is there maintenance, disposition, all kinds of fees that you can be feed to death, which again affect your return, but also affect in the case of, for example, bankruptcy. When in bankruptcy, what would happen is outstanding bills would be paid, and then investors would be paid. And as we don't, other than some operating bills, which are significantly low, we don't have any additional credits, or sorry, loans to pay off. So investors would get paid first. And this is where the value of the homes also could come into play when we're selling assets. How many loans do you currently have in your portfolio? And typically, how many do you hold at any given time?
Great question. We are constantly buying and selling loans. literally on a daily basis. So we fluctuate today anywhere between 100 and 130 loans within the portfolio. The typical hold time is approximately, 18 months. Is the average, could be 12 to 24 is kind of that range, depending on the time of workout, and then taking 8 to 12 months to get those borrowers on reperforming as well. And that's kind of also behind the scenes, like why is it a 4-year fund, is because we want to make sure we can get 2 turns of, rounds of, notes within that at a minimum within the offering.
Is there an investor gain on the back end if the loan sells for more than the purchase? So no, so when you look at investments, again, this is kind of, again, not investment advice, but this is as a personal, someone who also invests. When you look at kind of what your portfolio and balancing your portfolio, typically have your growth investments and your income investments. So this is in that income bucket, meaning we are paying a preferred dividend. There is no upside or growth on the back end, with the disclaimer, or with the kind of side note, that bonus shares, I guess you could look at as a kicker on the back end. So how bonus shares work, for example, is if you invest $25,000, we are going to give you an additional $1,000 that you would collect 8% on annually. So you get 8% on $26,000. And then on the back end, you can, when at the end of the 4 years, you're also able to redeem that extra $1,000. So you'd get back the 26. Now, and that scales, the percentage of bonus share scales depending on your investment amount. So the tiers are 25, 50, 100, and 250. So you get a higher percentage of bonus shares depending on at which point or at which tier you invest in. Someone asked about self-directed custodians, self-directed IRA providers or custodians that we'd recommend. So if you want to reach out to us, or I will actually have one of my team members reach out to you. There's so many of them that we love to work with, but off the top of my head, I would say Quest Trust, Strata, and Advanta, probably. Again, always do your own due diligence, make sure you call them, have a conversation, see what their fees are, see what their customer support and service is like. I think that is a huge, for self-directed custodians, that is a, big part of it. So, however, we'd be more than happy to send you kind of a list with some contacts as well. So,
and just to add that, it's also very dependent on how much money you're putting in, because there's fees associated with that. And certain ones are built for larger portfolios or smaller portfolios. So it's not kind of a one size fits all.
what are your competitive advantages over other mortgage note investor groups?
You want me to take it, or do you want to start?
You can go ahead and then I can answer.
Okay. So most people will probably start by saying, their people, their experience, their team, which that is the case, because we do have our people. They're all employees of the company. They all have vested interests. They're not, they're all, I'm in
US
Virginia.
based.
Yep. They're all US based. But one of the things that I think we talk about a lot too is our size. And what I mean by that is allowing us to cherry pick the loans where we are at a size, and we want to build ourselves to a size that allows us to buy in bulk, that gives us a discount, as well as cherry pick the loans. Because what a lot of these large funds do is they'll buy 10,000 loans, and they will just aggregate, okay, on 10,000 loans, this is what we'll pay, without even looking at them and understanding that, hey, we'll win some, we'll lose some. For us, we take a very different approach of, we look at every single loan and put a value on that loan, not on a portfolio. So I think that is something for us that is a big competitive advantage over the competition.
Yeah, I also, this goes to people, but I think like street cred is the only way I can really sum it up. There's a lot of people who claim that they're experts in this space, and that's definitely not the case. Or they may have done a few deals and now they're launching a mastermind or a course. And look, like, nothing against learning. I definitely have invested in real estate back when I was, getting into what I wanted to do in real estate, different, educational seminars. But I would always ask other people, not other investors, or read reviews, Google them, go to Bigger Pockets. Bigger Pockets, if you're not familiar, is a great place to get feedback on different sponsors and what their other investors who have invested with them. You can go sign up for a free Bigger Pockets account, go search their forums. I see people posting all the time. Hey, has anyone worked with Chris Seveney and Seveney Investments in CWS? What are your thoughts? I'm considering investing with them. You will get very honest feedback, good and bad. There's thousands of people who are members there. So that's one place I always point people to. Google searches, track record, like talk to the person. What have they done? How many deals have they done? I feel like a lot of times it's not knowing what to ask that gets us in trouble. So kind of coming up with your preset of questions that you need to feel comfortable investing with someone. So I don't know if that's a competitive advantage or me just giving advice on, due diligence in general. I think, again, our track record, our team, and our communication. So something that we don't advertise, but I feel like we probably should, is the amount of people who reinvest with us is astronomical. So that's huge in that we know that we're doing our job in communicating and keeping, we provide case studies, we give quarterly updates. You always know you're going to speak with a person within, hear from a person via email or on the phone within 24 hours of like submitting a response. You're not going to speak with an automated dialer or machine. And we're always there to really, our investor relations team is always there to be very open and communicate what's going on. Our distribution cadence, someone asked about when we issue distributions, we do that monthly. So for example, anyone who invests by December 31st, their shares are issued January 1st and they receive their first dividend February 1st. So it's also a quick turnaround time, meaning, you're not waiting. And this is, again, the investor in me should probably build a list of questions I would ask is how quickly does my return kick in, start accruing interest? And when's my first payment? Because sometimes you can invest and not see a payment for 6 months, a quarter, a year, whatever that might be. So another great question to ask. Not patting myself on the back, just saying something I would ask.
Wayne has that list.
Yeah. Is the investment a minimum of 4 years? If I want it out in 2, how does that work? So great question. So it is a 4-year lockup. And to answer your first question, if I want it out in 2 years, how does that work? So it depends. So we do have a death and disability clause in our offering. So if something were to happen and we had the documentation, you would be able to get out penalty free. Now we do have early withdrawal penalties that would apply if that was not the case and you needed to get out or wanted to get out of the fund. So it starts at 12% and goes all the way down to 5% in year 4. So it just depends on at which point you'd like to redeem. Now, something you didn't ask that is also important is at the end of 4 years, people ask, well, what happens then? So this is more of an evergreen fund, meaning that the minimum lockup is 4 years. So after that, it's kind of, I don't know if you use this term in California, it's used a lot, but at will or month to month, like a month to month lease. Essentially, you can redeem at the end of 4 years and walk away. You can partially redeem, or you can continue to accrue 8%, and then you would just give us notice on when you wanted to redeem.
I'll just add to that, Lauren, too, because that second half is a great point that, when you look to invest, again, are you tied to a specific asset or you're tied to a fund? Because if you're tied to that specific asset and that asset doesn't get liquidated, then you might be tied. It might have to be forced to stay longer periods of time versus coming in sooner or getting out sooner. So after the 4 years, you can, request that distribution. And the other thing I'll just mention is, with every offering we've ever invested, because we don't take on debt, we have never had to even consider a capital call within anything. So I just wanted to kind of mention that as well.
Awesome. Well, thank you. We've just over an hour. So thank you guys so much. If you stayed on through this whole thing, if you didn't, or you had a job, we will send this out. Again, thank you guys so much for joining us. If you are interested in investing or speaking with someone on our team to learn more about us, our process, our portfolio, I'm going to go ahead and drop a link to the presentation in the chat right now. And you can go, I'll say it as well. You can go to 7einvestments.com/invest. Again, I will put this out to everyone in the chat right now. 7einvestments.com/invest. And from there, you can kind of look at an overview of the offering. You'll also be able to have the option there to schedule with a member of our team and speak with them. And I'm also always going to throw this out there. Feel free to email me directly, Lauren@7einvestments.com. And again, thank you guys for joining us. And we will have a copy of this presentation and webinar out via email. So if you know of anyone who is looking or is into investing with in an alternative, this is a good place to start, or kind of just educating them on what we do here at 7E.
Thank you all.
Thank you. Bye.